All right, back at 44 minutes after. Now, the credit crisis caused some serious pain for companies relying on leverage, especially Goldman Sachs and Morgan Stanley. But signs in the bond market say these financial firms are getting back on their feet. Our Christine Harper is Bloomberg's chief financial correspondent. She wrote this exclusive story. So, Christine, talk to me about the bond world. What's it kind of saying right now about these financials?
Well, Carol, as you know, the bond market is really sort of the primary regulator of companies like Goldman Sachs and Morgan Stanley. It tells them what they can do and what they can't do, whether they think the companies are acting appropriately or not. Right now, the bond market is telling these companies that they look a lot better than they have since Lehman Brothers collapsed back in September. At that point, these companies seemed okay. All of a sudden, with Lehman going bankrupt, the bond investors fled them, and now finally there seems to be more confidence restored.
I hate to make the jump, but what are you hearing? I mean, are people then thinking, from what they're seeing in the bond market here, that the worst of the crisis is over?
Well, certainly that's why the bond investors are getting back into this. They've seen the stress test. They've seen Morgan Stanley and Goldman have both raised more capital. They've taken down their leverage levels. They've also become bank holding companies, as you know. And that gives them more access to the Fed for borrowing overnight and posting collateral. The difference now is that
I'm just, I'm thinking we've got for viewers, we're showing the spread for Goldman Sachs. And, I mean, that just shows you how much it's come down, right?
Yeah, exactly. I mean, that's the difference between what people pay to own Goldman Sachs or Morgan Stanley debt versus owning a Treasury bond. And back in the heart of the crisis, people just wanted U.S. Treasury debt because that was considered the safest.
And that's the spike that we're seeing. Here's Morgan Stanley as well. So that's the spike we're seeing.
You see back in September and October, people were terrified to own these bonds.
What I thought was really interesting in your story, Christine, is you talked about some who actually say that investors should be demanding higher risk premiums for Goldman and Morgan at this point.
Well, some people are concerned that this has gotten too far too fast. Just because those stress tests are over, there's still a lot of things that are negative in the market. I mean, until just a couple of months ago, these companies had to rely on FDIC guarantees to issue any debt at all. They've started to issue debt now, and now it's priced as though the crisis is pretty much over. But as you saw in September, that can change.
What about other banks? We're talking about Goldman, Morgan Stanley here. What about other banks here?
JP Morgan still has lower borrowing costs than either Goldman or Morgan Stanley. It's still viewed in a class of its own. Citigroup and Bank of America, which haven't repaid the government, they have higher borrowing costs, although they can still rely on FDIC debt guarantees.
All right, so higher borrowing costs. I'm thinking, how's this going to play out on earnings, especially for those where it's come down a lot?
Yeah, I mean, interest costs are one of the big expenses for any of these banks. So if you can bring them down, it's a big difference, and it makes it a lot easier to earn money over that cost. A lot of the analysts are expecting that both of these firms will benefit. However, they also sell the types of notes that they have to mark down if their credit spreads narrow. And so for Morgan Stanley, that was a big cost in the first quarter. In the second quarter, a lot of analysts are expecting that again.
All right, so keep a watch for all of that. All right, great. Christine, thank you so much.
Thank you.
Bloomberg News' Christine Harper.